Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Elkanah, and we're joined by Kevin Kelly. He's the Chief Investment Officer of Recon Capital. As the Chief Investment Officer, Kevin oversees all research and investment strategies. Kevin, thank you for joining us this morning.
Thanks for having me. Appreciate it.
Absolutely. Well, it's been a little over a month, I want to say, since the last time we've had you on, and Black Monday has happened since then. How have you been navigating these markets since that happened?
I know it keeps it exciting for us, right? Especially before Labor Day. So one of the things that we look at is that we're in this in between period where companies have stopped the majority of companies aren't issuing earnings. A lot of companies actually have to stop their buyback, so it tends to lead to being more volatile. So what's going to dictate a lot of the market action, especially what we see, is government noise or policies, politics. And so it's really getting a firm understanding of what you want to be involved in and what you can actually scoop up. Now, Black Monday, that happens a lot, and I think it underscores people really need to rely on, trading mechanisms in the market. So making sure you don't have those limit orders that you get stopped out. If you have an ETF, down 20%, you've got to use market limit orders when you're trading. So it really underscores how to participate in a market. It's not 100% efficient. It's gotten a lot better since we've traded since under the buttonwood tree, but there still are some inherent problems.
So what's kind of your advice for investors when that sort of market volatility starts to take place? What do you think the best thing for just the average investor to do is?
I think the best thing to do is to figure out what you really, really want, and also to be diversified. So there are some great names out there that, people were like, when Facebook was coming out with earnings, it was trading at $95. Everyone was so bullish on it. And then all of a sudden we have Black Monday, it comes down to 87 and people don't want to touch it. What fundamentally has changed? Absolutely nothing. If anything, you should be going in and purchasing that, especially if you believe that the fundamental story is still intact and there. And so, we've heard that it's funny. People wanted to buy it at 95, but they don't want to buy it at 87 here. So, and nothing's really changed. If anything, the story has gotten better. So I think that's the key. And the key is being diversified. A lot of people get enamored, but they meet with certain stocks and they fall in love with them. But, sometimes when the story breaks down, get out of it. If the move down was fundamental, get out of it and move into something else or stay diversified. So that's basically our keys to people.
General overall market weakness lately, are you seeing any pockets of strength anywhere?
Yeah, there's tons of pockets of strength, and this is a great time. The market is trying to digest global growth. This is a global scare, especially with China. And the China story isn't really new. I mean, the PMI has been consistently under 50, which is their manufacturing index, under 50 for 3 years. So, shy away from energy. It's too volatile. It's dragging on the overall S&P earnings, so it's going to drag on the overall headlines. But if you stick to market leadership within tech, within healthcare, you can find some great buys. So, I'm actually heading over to London. A company that's based there is Arm Holdings. Arm Holdings trades here in an ADR, ARMH. They're trading below their 5-year historical PE level. They are down 25% since that Black Monday. But what's nice is they're growing revenues 17 to 20% year over year.
Wow.
Their royalties are in over 1 billion chips for the Internet of Things. So you have Qualcomm licenses their technology for their Snapdragon processors. You have a lot of Chinese companies starting to use them, like Xiaomi. So they're a great company that you can pick up, and they even pay a 1% dividend. So I think there's a lot of great names that you can start going bargain hunting for.
What about something like Apple? Do you think that would have been a good bargain for Black Monday? Especially we've got this event coming up today. Investors will probably be watching the stock when it comes on around 1 p.m. Eastern time.
Yeah, listen, Apple's a great company. It's well run. They've got great products. They're consistently going to have a captured audience because they have an enterprise ecosystem where people are sucked into it. So the issue is the whole refresh. And one of the reasons why is because you have carriers like Verizon no longer giving subsidies for the phones. So with that being said, you're going to have a drag on the multiple, the PE multiple, and that's what we've seen until we can see the growth continue, especially because China has slowed down. But Apple is a great name. They pay a great dividend. They're well run. They've got a great balance sheet. They're still buying back stocks. So that is a great name on a Black Monday to go in and buy, to add and set it and forget it. Don't get caught in the day-to-day.
What about something like Yahoo? There's been unconfirmed rumors that the IRS rejected its tax-free spinoff proposal. Obviously, Yahoo did a lot of great things with Alibaba, but other than that, it kind of seems like their main business line is a little unclear right now. What's your take on Yahoo overall?
The overall take is Yahoo actually has a core fundamental business that is worth something. The market isn't going to peg or give it a value until it can do something with Alibaba, and that's just how it's going to play out until they can figure something out with the Alibaba spinoff. Now, with the Alibaba spinoff, this wasn't an overall rejection. It was basically like a early admissions to a college, right? The IRS said, listen, we're not going to rule on this now. We're going to defer it. We're not formally rejecting you. You can still go through the normal process, but we're not going to give you an early action or an early decision. So the story isn't over. It's just gotten a little bit more convoluted. Now, Yahoo still has great traffic. They still have great properties with Yahoo Finance, Yahoo Fantasy Sports. They're trying to expand in those realms, but they're not going to get a value because there is the overhang. And to be fair, Marissa Mayer hasn't really added any shareholder value. I mean, we haven't seen anything drive the needle on the core business. She may be overpaid, and she's had some executives that have had to leave because they're getting paid too much. I mean, as a shareholder, there's not a lot of confidence in the company because management hasn't driven value.
What about something like Twitter, where it also seems like there's a lot of core fundamental belief in the company, but they can't seem to figure out how to generate ad revenue, and we're all kind of lost about what's going on with the CEO situation. I mean, do you have any thoughts about Twitter?
Yeah, Twitter is another great company that once they get a big overhang with the management out of the way, it can actually unlock value. And it gets more and more interesting every dollar it goes down because they've come up with, it's called Project Lightning. They've come up with this idea where they're going to revamp the whole ecosystem around Twitter where it's going to pull in news and be a better feed and be interactive, just like it was for when the women won the World Cup for soccer. And there are ways to monetize it, and they've got ideas around it. But because you have an interim CEO who's also the CEO of another company trying to come public, it doesn't instill confidence in shareholders. So they've got to get the overhang done and pick a CEO and move forward and have a clear direction and communicate that to shareholders, and they have not done that.
We're on the line with Kevin Kelly. He's Chief Investment Officer of Recon Capital, joining us here in Benzinga's pre-market prep. Kevin, I know you're looking at opportunities here in the U.S. markets, but you're also looking across the pond where you're going to be traveling pretty soon here. What opportunities, what indexes are you looking at overseas?
Yeah, there's some great indices over there that are providing lower PEs and higher yields than basically the U.S., right? And so if we look at Germany, you can see that they've actually come down pretty significantly. So the DAX is trading at a 12.5 PE. It's got a 3.2% dividend yield. And the top name is Bayer. Bayer is one of the top performing big pharma companies. I mean, their EBITDA was up 33% last quarter. Xarelto is a good biotech drug that's really drove revenues for their healthcare division. Its revenues were up 45%. The healthcare division was up 28%. So they have top line biotech, and they also have bottom line over the counter. So it actually trades here on the pink sheets, BAYRY, but you can also get access to it through either the German market or you can find ETFs. It's in all the top German ETFs here in the States. The overhang on the German market was the autos. 15% of the German DAX index is the automobile manufacturers, Daimler, BMW, Volkswagen. They've actually stabilized here. They've already reduced guidance. So they actually have a way to surprise to the upside going into the fourth quarter because they've been being so down by the Chinese story. There's also value over in London. There's several companies over there. So I mentioned ARM Holdings earlier that are doing well. It provides over a 4% yield. It's got a 15% PE. London actually may raise interest rates before the Fed does because they are having wage inflation. Their GDP is growing at 2.8%. So it's actually a really decent market to find value. You can pick and choose or find any ETF that trades and focuses on the United Kingdom.
Kevin, that's a really interesting point that you made, thinking that England might raise interest rates before the United States, because so far most people, or a lot of the sentiment has been that they're just kind of going to follow in the Fed's footsteps. And once they see a rate hike from the Fed, then the Bank of England might also move in the similar direction. But you don't think that's the case?
No, I think the most important thing that people are overlooking is that the Fed will not raise rates because that will mean a stronger dollar. You saw Beijing implement a policy on devaluing the yuan before September, and they did that for a reason. Everybody was pricing in a rate hike, and it scared the Chinese on their currency because they were pegged, and so that's going to have global repercussions. If the Fed raises rates in September or December, what are the Chinese going to do? Are they going to devalue even more? I mean, they've already lost out on exports. I mean, going back to Europe, Germany's exports were up 8% in July, while China was down 8%. And that's because the euro's gone down and depreciated 25%. So the Fed will actually look to their friends at the Bank of England to raise before and see how that impacts other currencies. So, they've got a stronger story with their economy as well as the targets than the Fed does. So the Fed can't raise because of the stronger dollar. And unfortunately, that's as simple as it gets.
Kevin, let's take a look at some of these ETFs. I'm looking here at the United Kingdom ETF here. Technically, I know you do your fundamental work, but I looked at both the EWU and also the DAX, and they look like they're just coming up against some resistance here. Do you trade these technically at all? In other words, if we break above, let's say, in the EWU, it seems like there's major resistance at the 1720 area. Will you be more inclined to add to your position, or how do you approach it?
Yeah, so we sometimes look at fundamentals. One of the reasons why we do that is because we can see overall sentiment in weak periods. And so typically the summer is a weak period for a lot of European stocks because they're coming off Q2 in the spring earnings, and then they're really trading off of technicals in the summer. I think when you start having the early October, you can't rely on technicals because a lot of these names, I mean, they're up always like 4 to 5% off earnings. I mean, going back to Bayer, they're even spinning off a company in the fall, their plastics division. So right now, it's a good time to rely on technicals, but once you start getting to the late September, early October, they're going to start issuing earnings, and then it's all bets are off.
All right. You have an ETF here, and it's the QYLD. Tell us about that.
Yeah, so the QYLD owns all constituents in the NASDAQ 100 in their proportion. So Apple, Microsoft, Google, Qualcomm, Intel, Netflix. But then what it does is it actually sells the index option against it. So it sells a NASDAQ 100 front-month call option against it to take in the premium. So what it does is it lowers the volatility of the overall NASDAQ 100, and then it generates some options premium. So then what we do is we actually distribute monthly options premium to the shareholders. So every month we consistently pay that out. So when we roll the position, we end up distributing it. So you get it typically within a week after we roll the option.
Now, what were you thinking on the flash crash when this thing went down to 1796? I see it had a big volume day. Obviously, short the calls gives you some exposure on the downside. I mean, did you? I mean, were you expecting to see that kind of level that day? It closed at the previous day at 2218.
Yeah, no, we were not expecting that. And one of the problems is because a lot of the stocks that were in the actual index were halted. So they didn't even open. So market makers could not price the ETFs. So they were basically assigning extremely low values to the stocks because they weren't getting appropriate market information. So having it go down to the 18 level, I mean, was kind of what you saw the same type of action in like the SPY, which is the S&P 500, dividend ETF. So, I mean, that was down 40%. So that's the problem with the market mechanics we're currently seeing is that, when a stock can't be open, you're going to see mispricings. And so, we'd like to see regulators say, okay, if 40% or even 20% of an ETF's assets aren't being traded, then the ETF should be halted or suspended, until all constituents are open. So we saw that happen, but it was not a fundamental. It was more of a market anomaly. And if anything, the option protected us because we sold a higher strike option. So we ended up, that moved in favor for shareholders on the downside.
Okay, all right. Just final thoughts of the market here heading into the open. We're coming up on the recovery high. Just give us your thoughts here.
Thoughts are it's going to be choppy next couple of weeks. We're going off of macro and headline news. So, stay nimble, but it's going to be an exciting time and get your buying list out.
Okay, all right. Thanks a lot. We've been on the line here with Kevin Kelly, Chief Investment Officer of Recon Capital.